Hi guys, and welcome to this full-fledged tutorial on what is financial modeling, and possibly this will also give you an idea on how to actually apply financial modeling. So the entire template will be available on the description below, right? So it's posted out, so you can actually try to practice it with me. There is no background required to do this model, right? So I've taken a very simple example as opposed to doing an equity valuation model. I've taken a very simple business case so that it's more relatable, and you really don't need any financial knowledge before approaching this model. So let's get right to it. Okay, so I've taken this case which I had built a long time back, right? And I've been teaching financial modeling for about 8 to 9 years now, and I've trained about 3 to 4 thousand students till now on financial modeling across colleges, across institutes, across even corporates on how to actually learn this skill of financial modeling. And I checked out a lot of videos which are available on YouTube, and unfortunately, they all jumped into equity valuation because equity valuation can be done, but the problem is you will need some background to understand this, right? And I wanted to make this video for people, even for people who did not have the background or whose accounting might not be strong at the moment as we speak, right? So I've taken this case of building a financial model for a business, and now the business that we have actually taken up is to start a Volvo service between two cities, all right? uh, so I've taken some assumptions out here. So if you see in a financial model, you generally the most important aspect of a financial model is the assumptions. All right. So because if your assumptions are wrong, uh, your model is as good as your assumptions, right? So people tend to become very fascinated with the template, but templates are something which you can learn over the course, right? But researching on the assumptions is the main and major part of financial modeling. Okay, so a simple example of a bus service which you are starting between two cities, right? The cost of the bus is 75 lakhs, right? If you see out here, we have taken a maintenance of the bus as a percentage of the cost of the bus, right? Now these are just simplification of assumptions to make the modeling process simpler, right? Instead of just adding what maintenance cost will be there for, let's say, how many times we will change the tires, or how many times the bus engine will break down, and a lot of other things. Instead of just adding up one by one, it's better to take a assumption basis a percentage of the value of the asset, right? Now if you see here, we've taken an escalation rate. Escalation rate basically means by how much percentage will this cost of maintenance increase year on year. So that's 15%. The life of the bus we've assumed as 4 years uh, for simplification purposes, because we just want to complete a model as short as possible, because you really don't want to make a 10 years model. It doesn't make sense, right? Depreciation rate we have assumed as 25%, so it's equal linear depreciation which we have assumed out here. But in the real world, it might be a little different basis on which part of the world you are, on which accounting principle you're following, right? But for now, we assume that it's 25% straight line method, right? We come to the operating assumptions. So the seating capacity is about 35, and we have taken a load factor of 50%, which means that at a point in time, the bus will be occupied 50%. Okay, so generally when you're making a financial model, you want to make sure that you take as conservative assumptions as possible. Specifically, the reason being because the optimistic assumptions will play out as it is, right? So you could definitely check out for the optimistic assumptions, but you want to make the assumptions as conservative as possible, so that you understand that even if things go wrong, your real plan would work out as your real plan would be as close as possible to the model, right? So never make a model which is too optimistic, right? Which might not be actually real also, unless you have a basis for that, right? We have assumed a tariff of 300 rupees. If you're watching from some other country apart from India, consider this as dollars. All right, escalation rate for the tariff for the ticket I've assumed as 10% year on year. Coming to the second part of the assumptions, if you see, this is my financing assumptions. I am planning to take about 75% debt for financing the bus. Remember, the financing for this model, we are assuming of the asset that we're purchasing. We are not talking about the working capital financing. Okay, we're not talking about operational financing. We're talking about capital expenditure. All right, the equity part, which is going to be my contribution, is about 25%. Right, interest rate, place like India, I've assumed it as 15%. Okay, the loan tenure I have assumed as 4 years, and the cost of equity. Now, what is cost of equity? Is to simplify things, cost of equity is my opportunity cost. All right, that means if I were to not pursue this business, right, how much return would I have been generating anyways, right? So if I was a businessman already and I'm generating 20% in my previous businesses, then my cost of equity would be 20%, right? So I'm just trying to simplify this. Of course, there are multiple ways by which you can derive cost of equity, but I have just given you a very simple explanation, right? Now, operating cost, this is related to running the business, right? So the fuel efficiency, I've taken it as 5 kilometers per liter, right? The driver cost, that means per trip, how much is my cost to pay the driver, is about 500, right? Miscellaneous expenditures, which could include so many things, right? I have taken it as 500 rupees. The total amount per trip is going to be 500. All right. So these are operating cost assumptions. On the right, I've got assumptions related to, taxation. So I'm assuming a corporate tax rate of about 33%, right? Interest income is 5%. So that this is related to the amount that I make from the cash that I have in my bank. All right. Then I've got diesel rate, is about 42 rupees per liter. Now this obviously, as we are speaking in 2021, has changed, but we can obviously change the assumptions later on once the entire model is made. All right. Diesel price escalation, I'm assuming it to be about 15%. All right. Inflation is about 10%, is what I'm assuming for miscellaneous expenses. So if you just see out here, we have assumed the inflation for miscellaneous expenses, right? And these are your operating general assumptions. The distance between the two cities, which is, for now in this model, we have assumed Bombay and Pune. So that's about 155 kilometers. And estimated time taken for one trip is about 3 hours. And how many trips a day does this business make? Is about 4 trips, right? So these are my basic assumptions, which I thought I will explain you before I jump into the calculation, right? So as you have the model with you, the template with you, you can start and practice with me instead of just observing. Okay, and you absolutely don't require any background to do this calculation. So let's calculate the revenue first, right? So as you can see out here, we've somewhat made a format of an income statement, right? A general format does not really have to be in line with a certain accounting standard, because you use financial modeling for your own purposes for decision making, right? Unless of course you want to convert this into a accounting statement as well, right? Then you could obviously do it, but in most of the cases you're using financial modeling for decision making purposes, so the formatting does not really have to match with a certain accounting standard. All right, so if you can see out here, we've got year 0 to year 4. Year 0 basically means the year of investment, right? And our business starts from year 1. So all the operations usually start from year 1, okay, not from year 0. All right, so let's calculate the revenue first, the top line, and in the process I will be explaining all the other line items which are written out here. So let's go ahead and calculate the revenue first. Okay, so if you think logically, revenue, because we're talking about tariff, right? Obviously we are charging some ticket price, so there you go, 30%, right? And then I'm multiplying by it. If in a bus, I'm talking about one single trip and I'm talking about one bus, right? So that has a capacity of about 35, right? So if I were to calculate that, if my bus was fully occupied and there was no load factor assumptions, then I would make about 10,500 one way, right? But since we have a load factor, I would multiply that with 50%, right? So now I have the real calculation with the load factor. However, we're going to make these trips about 4 times a day. So I'm going to multiply that as well, right? And that should give me 21,000. So that means this is the amount of money that I make in a day, right? So again, repeating, tariff multiplied by the seating capacity, multiplying with the load factor and multiplied by trips per day gives me the amount of money which we make in this business in a day. Now you obviously will operate for 365 days. Transport services generally do not take any holidays, so we're going to multiply that with 365, and there you go, that's our revenue, right? So our first revenue calculation is done, right? Now you want to understand that how is my revenue increasing. We're not really adding any more capacities, right? So the only way by which any business, or even if you want to assume any business, right, even publicly listed company, it if you have to understand them basis a very simple factor or a calculation which can be called as price multiplied by quantity, right? So price multiplied by quantity, right? So now you have to see in this business, right, is the quantity increasing, right? So the only way by which the quantity or the volume of ticket sale can increase if we buy maybe another bus, or maybe the load factor increases, right? But taking an assumption on load factor is very difficult because we really don't know before starting the business whether the capacity is going to increase or whether the efficiency is going to increase, right? So for now we know that the price of the ticket is definitely going to increase by 10%, but usually it does happen too. So we're going to increase that value by that 10%, and I'm using a cell referencing dollar sign to fix that value, and we have 4 years revenue available with us, right? Now other income we really don't know because the interest income will be calculated at the end once we have the cash calculated for this business, right? So now let's go and calculate the operational cost, which is the first one is going to be the fuel cost, right? So think of it logically. Since you're talking about fuel cost, you need to know how much distance you have traveled, right? So if you see here, your distance is available at 155 kilometers, right? Oops. Right, so 155, and I have multiplied that with 4 trips a day, right? So this is the amount of distance that we travel in a day, right? And we will fix the referencing because we want to drag that formula to the right. And now since now you have the distance in a day, so you can multiply that with 365, so that will give you the amount of distance you travel in a year, right? And you divide that by the fuel efficiency, so because it's kilometers per liter, so by dividing that by 5 you get basically how many liters of diesel you will require, right? So that tells us that we would require about 45,260 liters of diesel, and then you just multiply that with the diesel rate. So diesel rate is given on the top, and put a dollar sign. So there you go. That's about 19 lakhs 920 rupees as the diesel cost. Do make sure that whenever you're doing such calculations, use appropriate brackets to avoid any calculation mistakes. Even though it was not required out here, but we've still used it to keep that as a habit, right? Now, diesel price escalation rate, I have taken it as 15%, right? So put that dollar sign over there. There you go. Right now, diesel price could have also, the fuel cost would have increased also if the quantity would have increased. But in our model case, we have not assumed that the number of buses increase or either the distance traveled increase. We are not increasing trips either, right? And then drag that across to the right. Right now, maintenance expenses is a percentage of the bus cost itself. So it's 75 lakhs multiplied by 10% out there, right? So 7,50,000. And there's an escalation rate for maintenance expense. So 7,50,000 increases by about 15%, which is what the assumption we've taken, right? So 8,62,000 all the way up to 11,40,656 rupees, right? So we have the maintenance expenses. Now we get into the cost of the person who's going to drive this bus, right? So remember, again, the driver cost is calculated as per trip, right? Which is given out here. So we multiply the driver cost per trip with the number of trips he does in a day. So that gives us the amount of money we pay per day to the driver. And you multiply that with 365, which gives us the annual driver cost, right? And now does the driver cost increase year on year? So we all have to go and check the inflation assumptions out here. So if you see here, it is written that the inflation rate is applicable for the driver cost and miscellaneous expenditures, right? So we're going to increase that with the inflation rate. There you go, right? And similar calculation for miscellaneous costs. So miscellaneous cost multiplied by per trip, number of trips multiplied that with 365. There you go, right? And then again do the similar calculation using the inflation rate, increase it by the 10% rate out there, right? Drag it to the right. And finally, the last operational cost, which is toll amount. So let's take the toll costs. That's about 500 rupees per trip, multiplied by 4 trips a day, multiplied by 365. So that should give us the entire toll amount expenses for the entire year, right? Now, toll amount does not increase. There's no assumption where we are assuming that the toll amount is increasing year on year, and generally it does not. uh, Typically tends to get changed about 3 to 4 years after there's a gap of about 3 to 4 years when the toll amount actually increases, right? Now we're going to calculate the cost of revenues, right? So this is the direct cost of generating the 76 lakh 65,000 revenue, right? And if it was not related to service, then this cost of revenues would have been called as cost of goods sold, right? So let me drag that across to the right. There you go. So we have the cost of revenues, right? Now, if you see out here, I've written gross profit slash EBITDA. So the reason why it's slash, because we really don't have selling, general and admin expenses. If we had selling, general and admin expenses, we would have first calculated gross profit, then then calculated the gross profit, then reduced SG&A, and then would have got EBITDA, right? But in this case, our gross profit is actually equal to EBITDA. So we will do revenue, and remember to add the other income, right? Because later on when the calculation will come in, the value will come in, then we don't want to miss out that other income calculation, right? So there you go, that's our gross profit. Drag it to the right. Depreciation, as we discussed initially, it's a simple straight line method. You can multiply that with 25%, or you could divide that by the life of the asset, right? The answer would be same. So 18 lakh 75,000 is the depreciation interest expense, right? Now we don't have the value as of now. So let's do one thing for now. Let's just include it in the calculation, and we will calculate the interest expense separately, right? So we have the interim profit before tax, right? And now let's calculate the income tax. Now, when we want to calculate the income tax, we want to make sure that we use an if statement, so that if in case the profit before tax is negative, then you don't want any tax to be calculated, right? So the logical operator we are using is if function. So if the profit before tax is greater than 0, then value if true is to do the normal calculation, right, of 33%, right? And the tax rate is given on the right side. I'm going a little faster because I'm assuming that you have the liberty to pause me and come back to the calculation again, right? And if the profit before tax is not greater than 0, then value of false will be 0 tax, right? There you go. So that's income tax calculation, right? And profit after tax is going to be profit before tax minus income tax, right? So that gives me the interim PAT without other income and interest expense, right? Now what we're going to do is quickly try to create an amortization schedule on the right, right, to calculate the interest expense, as well as we will be requiring this schedule for purposes of the balance sheet, right? So as I said, the investment happens at year 0, right? So year 0 is when we are actually buying the bus and we are investing the money, right? So the debt we are taking at year 0 is the cost of the bus, right? And you multiply that with the financing rate, which is 75%, right? There you go. And so at year 0, we have 56 lakhs 25,000, which is raised. So that becomes the beginning debt for the next year, right? And interest expense is calculated as, always calculated as, beginning debt multiplied by the interest rate. So if you see the interest rate is given out here as 15%, right? There you go. Now, we will use the PMT function to find out the equated annual installment. So the rate out here is given above, just like before. The number of periods of the loan term is 4 years. The present value is obviously the loan value. The future value of loan is always 0 and type is 0 because it's ending cash flow, right? Now sum it up and there you go. That's your ending period debt, right? Now all you got to do is you got to just take all the values and copy it to the right and you'll have your amortization schedule, right? And you could calculate the principal repaid also as beginning debt minus ending debt. There you go, right? So in your balance sheet, this will be reflected as your borrowings, right? And in your income statement, this is what will appear as interest expense. And the principal repaid will be reflected in the cash flow statement. So we will see that how that happens. But for now, let's link the interest expense out here, right? So since we had already figured that out in the calculation, so the calculation was automatically changed, right? So if you see here, the first year profit after tax is about 70,571, right? Now let's come to the balance sheet. Now in the balance sheet, cash amount is what we will get from the cash flow statement, so leave it out, right? Cash flow calculations are not directly done in the balance sheet, but we can start with the property, plant and equipment gross value, right? The gross value is the value without the depreciation. So let's link that from the asset. So that's my gross value. And the gross value doesn't change because that's the amount of assets that you have purchased till date without considering the depreciation. All right. So now we will calculate the depreciation. So if you see out here in a financial model, one more thing to notice is between the calculation and the particulars that you've written, we always try to give a blank cell so that we are able to do calculation something like this. So last year plus depreciation. So even though there's no value out here in the D column, I'm still doing this because we can just drag it to the right. So there you go. That's your accumulated depreciation, and calculate the ppnet, which is gross minus the accumulated depreciation, and that should give you the ppnet, right? So now total assets will be either you can use a sum function. Okay, so just select the cash and select the pp net and drag it to the right. So your asset side of the balance sheet is interimly made without the cash value, right? And now debt. So debt, remember we calculated the amortization schedule as it is. So we just need to link the debt values. There you go. And now equity value will be the bus cost multiplied by the equity percentage, which is 25%, right? There you go. And the equity value doesn't change because we are not adding any more equity in the business later on. Now retained profit is again similar calculation like your depreciation, last year's value plus the net profit that you're making every year. There you go, right? And drag it to the right. Now what you do is you just add up, and you'll see that the first year matches automatically. The reason being there's no other transactions apart from buying the asset, right? Now from year one, you see that the balance sheet does not tally, and this is precisely the calculation that if finally the cash amount will come out here, then this balance sheet will tally by itself, right? So now let's come to the final part of it, which is to calculate the cash flow statement. Okay, now cash flow statement also similar to balance sheet, you will start making it from year zero. So net income, link the net income, and this is also called as the indirect method of creating a cash flow statement, right? So now what we're trying to do is we're trying to use the net income to add the non-cash charges, because remember depreciation is not really a expense in cash, and cash flow statement reflects the actual cash generated by the business, right? So we're adding back the depreciation from the income statement. Remember never to link that from balance sheet. Add that up. Okay, then capex is now very simple approach to calculating the capex, the debt repayment, is to remember some a very simple principle for asset and different for liability. If it's in case it's an asset, what you do is in the cash flow statement do last year's value minus current year value. If it's a liability, this or current year value minus last year value, right? So the reason why I say that is because if you see, if there's an asset of, let's say if you had an investment of 10 and in the next year the investment is 20, so if you use this principle, it would automatically show you a negative value, and negative value would mean that there's a cash outflow, right? So this will show cash outflow if in case the asset value increases, right? If you take liability, right, so if there was a loan of 50 and in the next year the loan value increases to 100, right, so that would mean that you raised loan, and since you raised loan the cash comes inside the bank account. So if you take this year minus last year, it would give you a, a positive value, right? So that it signifies a positive cash flow. So just apply the same thing here, since Capex is related to gross fixed asset and gross fixed asset is a asset. So last year minus current value, so it automatically gives you a negative value. So that's your cash flow from investing. Debt repayment is again liability. So this year minus last year, so this should give you a positive value. Again, equity addition is going to be, since it's a liability value, right? So it's this year minus last year. Remember, whenever you're trying to find change in equity, you don't want to calculate that for retained profit, right? Because retained profit is actually coming from net income in the income statement. So that is already taken care of. So you want to do equity, meaning contributed capital, right? So that's your equity addition. Now this add this up, right? And then you have all the three sections. So just add cash flow from operation plus cash flow from investing plus cash flow from financing. So that will give you the net change in cash. Now BOP cash is again just like the debt calculation. The beginning period of any value is the ending period of the last value, the last year's value, and EOP will be beginning period value plus net change in cash. And now just take all the values for year 0, copy it, control C, and paste it across for year 4, right? And if you see here, the balance sheet by amount by which it does not match actually matches with your the checksum, right? If you see the ending period values, it will exactly match, right? Now what we do is we just go to our balance sheet and link our EOP cash, right? And that will make the balance sheet tally, right? So there you go, that's your balance sheet which has got just tallied. Very simple. And now finally we want to come into the section of calculating other income, right? So other income, remember the interest income what we assumed is 5% of beginning cash, right? So we're going to multiply that with beginning cash and drag it, right? Now it's an assumption, so you could obviously calculate as average cash also, but I've assumed that it's beginning cash. So there's always this is the analyst discretion on whether you want to take as beginning or you want to take it as average, okay? Now finally, after doing all of these calculations, you want to finally calculate how much money, or in terms of returns, how much have you made, right? So uh, basically what you're trying to understand is how much money does an equity investor in this business get as the final cash flow, right? It doesn't mean that he takes it with him. What it means is this is the amount available for the equity investor as a return or as a cash flow, right? So the way to do that is to see it from a cash flow statement perspective, right? So if you see from the cash flow statement perspective, right, if you see the first part, net income plus depreciation. So net income is obviously available for an equity investor, right? Then the depreciation is a non-cash charge. So the cash flow from operations is something that an equity investor definitely gets, right? But after that, what happens is he obviously has to invest, right? So now the investment obviously is done at the company level, right? So that means we have to reduce the capital expenses, right? And then we add the debt raised, okay? The reason why we do that is because not the entire 75 lakhs required for this bus was put in by the equity investor. So we added the debt. So net it will show how much equity investment was made by the investor at year 0, and then finally tell us how much cash flow is actually left, right? So let's see how that goes. So net income, let's link the net income from the profit and loss account. Let's link the depreciation from income statement. There you go. Capital expenses, you can take it from the cash flow statement. And the debt raised, you can take it from the cash flow statement itself, right? So that gives you a positive value. So if you see out here, this will actually, if you add this up together, it will show you the net investment made by the equity investors. And if you actually see in the balance sheet, this is exactly the equity investment done by the equity investment. So basically, free cash flow to equity we are using to calculate the returns for the equity investors, right? So the investment also has to be of the equity investors. Obviously, there are other ways of calculating free cash flow. You can also calculate the free cash flow for the firm as well, which would exclude the calculation only for equity. It would do the calculation entirely for the entire business, right? Now let's drag this across to the right. So we will have the entire free cash flow calculation available for us for all the 4 years. And once we have that, what we'll do is we'll just do a return calculation quickly. So let's drag this across to 4 years, right? And now, remember the cost of equity, which we spoke about initially, is 20%, which is the opportunity cost, right? So I want to find out the present value of all the money that I'm going to make in these 4 years, right? Now that's where the concept of NPV and IRR comes, right? So net present value, right? But finally, all you are talking about is net present value. So we can also use the present value calculation, right? So if we say this is 0, this is 1, this is 2, this is 3, and this is 4th year, what I could also do is just try to bring the year 4 value to year 0, right? So how do I do that? I take the value at year 4 divided by 1 plus the cost of equity. So I'm just discounting, right? This is the concept of discounting, right? And this method is also called as the discounted cash flow, all right? And I raise it to the number of years I want to bring it back, right? So it's 4 years, so raised to this value. And just drag it across to the first period, and you'll see that it does not have any effect on 18,75,000 because you're doing raised to 0, right? But year 1 definitely it comes back to the value changes, right, from 8,19,000 to 6,82,000, right? Now we want to calculate the NPV. So I'm going to show you two methods of calculating NPV. One is obviously to just add this up. This is the manual way of doing, and I would always prefer to do it manually because you can change some values out here, and you also know that you're not making any mistake with beginning and ending cash flow. What do I mean by that? Is that you also have the function of NPV, right? You could use the rate, but now there's a confusion generally for people, is that where do I select the value from? Should I take it from year 0 or should I take it from year 1, right? So I'll tell you the mistake. If you take it from year 0, your value will not match, right? If you see out here, there's a slight difference of about a 1 lakh rupees, right? But the reason why this is happening is because the first year when you actually select the NPV from here, right, the formula from here, what it does is it assumes this is first year. So that is basically doing a calculation as beginning calculation. So if you see out here, this is the calculation which is happening if you select it from here, right? So it is assuming that the investment is happening at year 1 rather than year 2, right? So that is how Excel has actually created the NPV function. Nothing wrong in it. The only thing is that we need to be aware that if under normal circumstances we want to take the rate and take from year 1 the cash flows and then add the initial investment separately, right? There are a lot of times when people actually go for finance interviews and they are told to calculate the NPV in Excel, they would do the calculation which I have shown previously, right? So you need to understand what is how to deal with beginning and ending cash flows, right? So this is our NPV for now, and let's select the IRR. So IRR is internal rate of return. Again, I'll explain you what exactly is IRR in just a minute. But for now, we have the return calculated as 35.95%. So that's the return on an average that the investor will make if in case he does this investment in this business, right? So that's the first part of it. Now what happens is, since remember all the assumptions that we had taken, right, for this business model, as I said, Your model is as good as your assumptions. So if your assumptions are incorrect, or if your assumptions are too optimistic, which does not show the real life, then your decision making will also go for a toss, right? So now what we want to do is we want to take certain assumptions. For example, we assumed that the debt percentage is about 75% and our equity percentage is about 25%, right? So what we could do is we could do a sensitivity analysis on this matrix that we have created out here. And what we want to do is we want to change the debt percentages, and we also want to change the interest rate percentages to check what happens to our IRR. Right now, it's not necessary that you have to do the sensitivity only for IRR. You could also do it for, let's say, NPV, right? You could also, it is not necessary that you have to do only for debt versus interest rate. You could also do it for maybe the load factor, right? So it depends upon what assumptions are important for you and what sensitivity you want to do. But it's a very, very important concept in financial modeling. So for now, let's keep it simple and let's link the IRR calculation, right? There you go. That's my IRR linked out here. And remember to, whenever you want to do sensitivity analysis, you want to make sure that you're selecting the data table in the correct manner. So you have to make sure that the assumptions are towards the border of the selection that you're making, right? So that's the first selection. Then you go to data on your home ribbon. In your data ribbon, you want to go to the right hand side forecast section and then click on data table. And now what the data table function is asking us is what exactly is in your row of your table and what is there in your column of your table, right? Because remember, what Excel is trying to do is it's gonna go in the calculation again, right? And it's gonna change these assumptions and it's gonna do the recalculation out here in the matrix, right? So if you see out here in your row input is the debt percentage. So you can go to the assumption section of the model and just select the debt percentage, right? And the column input, if you see out here, is the interest rate, if I'm not wrong. Oops, where am I looking? So this is the interest rate, right? So the interest rate, again, in the assumption, the original assumption is written out here. So now we have told Excel exactly what is there in our matrix and how the original calculation was done. Now press OK and you should have the sensitivity value, right? So Excel would have repeated that calculation multiple times and would have given you various answers. Now the way to check it is to see your original assumptions, right? So your original assumption was 70% debt. Is 70%, I suppose 70 or 75%. Yeah, 75%, right? So what you can do is, if you want to just check if your data table is made correctly, what you can do is just change your debt value, right? And your interest is about 15, right? So if you see to the left, it's about 35.95. If you just increase this decimal places out here, you should get the value, right? So there you go, 35.952. So that's how you check if your sensitivity analysis is happening correctly, right? So that's the first part of it, on completing the model first with the sensitivity analysis. Now, as I said, I wanted to talk about what is IRR. Most of the times people don't know what IRR is, right? They just say that the book definition says that it's the rate at which NPV becomes zero, right? However, the challenge with just stopping at this definition is the fact that you never actually understand what this means, right? So what this means is what I'm going to explain you right now, right? So for now, I'm just going to delete this calculation so that we have some clear space to work with, right? And if you see out here, and also forget about this, and just focus that these are the number of years and these are my cash flows, right? Now, if somebody was to tell me that, okay, why don't you find me the rate, right, the return in this business, right? So it would be a little difficult to calculate without, if I were to use the rate function in Excel, because this is for static cash flows, right? Because it's asking for PMT, because PMT happens only once, right? and it's happening for one present value and one future value. But the problem with this is we've got various series of cash flows, right? So how do you calculate present value in that case, right? Or the rate in that case? So think about this way. What if I were to tell you that if I were to find the present value of all these cash flows, right, I would obviously need some rate assumption, right? So let's say I take this as the blank cell for the rate calculation, right? And I raise it to the number of periods, right? So it's a hypothetical rate. Okay, so I'm just gonna color this to make it evident, right? So let's say I have an hypothetical rate. For now, I don't have the rate, but I'm just taking it as a blank cell, right? Oops, I did not put the dollar sign. There you go. Right? So for now, I'm assuming that's an hypothetical rate, right? But what if I were to tell you if there was a rate which could equalize the initial investment to the future cash flows, right? So just equalize the initial investment to future cash flows, right? So just a simple rate which could make the initial investment equal to the future cash flow. So that means if there was such a rate, the addition of all of this should come to zero, right? So that means, in other words, I'm also saying equalize, meaning NPV should become zero, right? For now it is not zero because my rate is also not figured out, right? Now this is where we will try out different rates. Remember the IRR which we calculated was 35.95, right? So let me create some hypothetical rates out here and we will accordingly calculate different NPVs. Okay, so let's start with a difference of about 2% all the way up to 35.95. Okay, so I'm just gonna take the IRR value so that you will see it spot on. Okay, so I have created some rates out here, right? Different rates, assumed rate, right? And I'm finding the NPV. So let's now use the NPV function and select the rate, and remember to select it from year one and then add the initial investment, right? So that's your NPV calculation. So if you see at 10%, of course it does not become zero, so it's not equalizing it. And as we oops, again I am making the mistake which I teach people, right? So just the D99 I will skip it, yeah, and we will just drag the formula down. Okay, so if you see out here, there is a point at which just between 34 and 37 there is a point at which the NPV becomes zero, right? So now if you want to actually go into the intricacies of finding a very small minute percentage, you could try out, let's say 35.9589, right? And it would take you more towards zero, right? And this is also the NPV IRR chart. So if I don't know if you have ever seen this in a chart, but this is how it looks, right? So the rate at which NPV becomes zero is exactly this. So if you see out here, you've got these different rates, right? And you've got this NPV, right? So if you see out here, there is a point somewhere in this graph where the NPV becomes zero, right? And that's the definition of IRR, right? And obviously there are some problems with the IRR. The problems with IRR calculation, right? So if you actually calculate the IRR, you will get the answer again. There you go, right? And if you see, the NPV becomes zero, right? So if you were to just plot this exactly out here, right? So your chart would look pretty accurate. There you go, right? So that's exactly the point where your NPV is becoming zero, and that's your rate of return. So that's the concept behind the IRR calculation. But IRR calculation actually has an inherent assumption that it assumes that all of these money that you're getting at every year is getting reinvested at the IRR rate, right? So basically that's a very faulty assumption, because that might not be true, because you might just take the business, the cash flows, and keep it in a bank account, right? So there is also a function called as the MIRR, the modified internal rate of return, which you could use to change that assumption. So that is my uh, value of cash flows, right? And then you could take the financing rate, which is about 15% in our case, and we could take the reinvestment rate at, let's say, about 17% or even lower, right? If, let's say, our reinvestment rate was about 8%, right? So it would give us a slight different calculation, right? So let me put that into percentage, and your IRR has dropped. Because now what I'm saying is, my money is getting financed at 15%, but I'm reinvesting at maybe the bank account. And if, let's say, you are getting 4%, then your IRR drops even further, right? So this is the MIRR calculation, right? There are also other functions like XIRR, but we will limit this to this class to just focusing on the model making. So this is the basic financial modeling process, and this is how you actually create a model, whether it's for an equity company, or whether it's you're doing it for a business, or whether you're doing it to a franchisee business. It really doesn't matter, right? The basic fundamental remains same. Obviously the scale of model will change if you were to actually take a large case like actually valuing a company, but for that you will require a background, and I did not want to do that. Right now, you could obviously go in your model and change assumptions. For example, the diesel rate was, if I take it for about $80 for now, right, and try to reduce the escalation, because the diesel rates in India have actually just recently increased. The inflation rate, we can take it as 6% for now, right? I'm going to change the tariff to about 400, which is the current rate, and yeah, about total amount can be taken as about 800. And you could see what actually changed in the model. So if you just go and see, your IRR changed to about 69%. Now the reason why that changed is because I changed the tariff, right? So if you actually had kept it at 300, then you would be making a loss, right? If you see, the calculation is a loss because your diesel rates have increased but your tariff has not increased. But if you kept it at 400 rupees, then you are profitable even at 80 rupees of diesel rate, right? So what I would suggest is I try to do as fast as possible to keep the video as short, right? So what you can do is you can pause the video, go back to the calculation again, and if let's say if you want to practice on your own, then what you could do is you could just pause it, do it ahead of my calculation, and then see if it matches, right? And this is just one of the basic models that we cover at MentorMe in our comprehensive 200-hour financial modeling program. Do press the like button if you like this video, and share with your friends, and also subscribe to my channel to keep getting such tutorials, and press the notification button so that you come to know when a new tutorial has been posted. So this is me. My name is Alan Arvindan. I'm a CFA chart holder and the founder of MentorMe, and I hope you like this tutorial, and I'll see you next time again. Bye bye.